Hello and welcome back. Now we'll start bond cash flow structure and options, and understanding how cash flows are structured and how embedded options can alter them is essential for valuing a fixed income security. So let's get started, and we'll move to the basics of the bond cash flows first. So let's begin with the fundamental. When you invest in a bond, you are essentially lending money to an issuer, which we learned, like to a government or a corporation. In return, the issuer promises a series of cash flows. Typically, this includes regular interest payments, known as coupons, and the return of the borrowed amount, which is your principal, at a future date. The specific arrangement of when and how these payments occur is what we call the cash flow structure. While many bonds follow a standard patterns, others have unique schedules that can change based on market condition or specific contract clauses. So bond cash flows are the contractual payments of interest and principal that defines the investment return profile. So, so the most common payment structure, which is known as bullet bond, this is often referred to the plain vanilla bond. In this structure, you receive regular fixed interest payment during the life of the bond, but you do not receive any principal repayment until the very end. The entire loan amount or par value is paid back in a single lump sum on the maturity date. This structure is a standard for the most government and corporation bonds. A bullet bond pays interest only until maturity, at which point the full principal is returned. Now, amortizing bond structure. Unlike bullet bonds, amortizing bonds pay back parts of the principal along with interest over the life of the bond. This reduces the outstanding debt gradually. We distinguish between two types. In a fully amortized bond, the fixed periodic repayments are calculated so that the principal is reduced to a zero by the end of maturity date. In a partially amortized bond, the payments also include principal, but they are not large enough to clear the debt completely. This leaves a remaining balance at maturity known as a balloon payment, which must be paid off. So, amortizing bonds reduce the credit risk by returning principal gradually rather than all at once. If you see the diagram, correct here, if we talk about here, general properties of the bond, which is amortizing bonds. In this case, they are all feature periodic payments, correct, and then uh, interest component and the principal component. That is what you would get. And fully amortized bond, zero balance at maturity. And if partially amortized bond, then balloon payment at maturity it comes in. Now talk about sinking fund arrangements. A sinking fund arrangement is another method for retiring debt early. It requires the issuer to set aside funds for redeeming a specific portion of the bond issue each year. The issuer typically forwards these funds to a trustee, who then retires bonds either by purchasing them in the open market or by selecting bonds randomly to be paid off. While this reduces the risk of the default at maturity, correct, which reduces the maturity for the remaining bondholders, it creates a disadvantage for those whose bonds are called early. These investors face reinvestment risk. Correct? We learned this concept as well, meaning they may have to reinvest their cash at lower interest rate. Sinking funds organize the orderly retirement of debt but can force investor to cash out early. So let's talk about in this diagram. If you see the sinking fund process, which start here, correct? Issuer sending periodic funds to the trustee, correct? Trustee get the periodic fund. The trustee then has a decision node. They can either buy the bonds back, okay, from the in the open market or call them via a lottery system. Both paths leads to the same result, retiring the bonds and reducing the total principal outstanding. So this is sinking fund arrangement. Now, not all bonds pay fixed amount, correct? So there are floating rate notes as well, which we discuss. FRNs have coupon that way. The interest rate is reset periodically, such as every quarter or 6 months. The formula for coupon is typically a reference rate plus a fixed spread or margin. For example, the rate might be the 3 months LIBOR plus 0.20%. Because the coupon adjusts to the market conditions, the price of a floating rate note tend to be more stable that, than that of a fixed rate bond when interest rate changes. So FRN provides variable income linked to the market rates, offering protection against the interest rate volatility. If you see in this diagram for FRN, correct, we have two inputs: the reference rate, which is this, correct, which can be LIBOR or anything, varies over the time, and fixed margin, which is also known as spread, which remain constant. This feeds into the coupon calculations here, correct, and your new coupon rate is derived. So suppose this is 5%, correct, and this is 1% or 100 basis point, then 6% your new coupon rate would be considered here, correct. Now let's talk about the callable bonds or issuer options in this case. So So this is the contingency provisions or embedded options. A callable bond gives the issuer the right but not the obligations to redeem the bond before it matures. Why would they do this? If market interest rate falls, the issuer can call the bond, high interest bond, and issue new ones at a lower rate, while saving the money for them. This is a great for the issuer but bad for the investor, who must now reinvest their money at those lower rates because of this reinvestment risk. Callable bonds usually offer a higher yield than non-callable bonds. The call options benefit the issuer and protect them against a higher interest rate. Similarly shown in the life cycle of the callable bond in the diagrams, and you see here the bond is issued, market changes and interest rate falls, then issuer benefits. Correct. Previously, when bond was issued at 6% was rate, and now market rate is 5%. So what would happen? Issuer will say, why would I pay 6% coupon? I would rather go for the level, and he would exercise these options and then early exit make it basically. Now, putable and convertible bonds. Some options benefit the investors as well. A putable bond gives you the right to sell the bond back to the issuer at a predetermined price on a specific date. This is a valuable if interest rate rise, as you can sell the low yielding bond and reinvest at the new higher rates. For another type is the convertible bond. This gives you the right to exchange your bond for a specific number of shares of the issuing company's stock. This offers the safety of a bond with the potential for profit if the company stock price soars. So put and conversion options offer investor protections and growth potential, often resulting in a lower yield compared to the option-free bonds. So if you see the diagram, the top note where the investor options, which branches out into two types. One is a putable bonds here, and another is a convertible bonds. So putable bonds, when rates rise, you prefer to sell back to your to the issuer, correct? Because they are high, you can get more interest in a new bond issued. And on the convertible bonds, if the stock price rises, the path leads to converting to the shares. Now let's summarize it. So the structure of a bond cash flow is crucial to understanding its risk and returns. We have seen that while bullet bonds pay principal at the end, amortizing and sinking fund bonds pay it down over the period or over the time. Floating rate notes adjust their coupon to match the market. Finally, embedded options like call options favor the issuer, while put and conversion provisions favor the investor, directly impacting the bond's price and yield. So understanding these structures allows you to better assess the true value of the fixed income security. If you see this map, which is generally mind map, bond structure defined is like there are coupon first, where floating rate FRN we have discussed, and a fixed coupon bond we have discussed. If you talk about the options, there are three types of things which we three options are available. Issuer callable, where issuer can call it; investor putable, where investor can put their bond; and investor convertible, where the bonds are converted; and repayment in the form of bullet, amortizing, and sinking fund is the option available. Thanks for watching. I'm stopping now. Please go through the accompanying ebook before appearing your final exam. Thank you.